Okay, let's go. Correlation matrix. What we want to use is Qiskit from IBM, the quantum algorithms. Quantum computing is the way to go. So let's apply it to the stock market. Here's a correlation matrix between various stocks in America. American Airlines, Alcoa, Best Buy, Home Depot. That's what we want to look at. We want to look at three stocks, which we'll have a look later, but this is the kind of correlation matrix that you want, which shows that, when Home Depot goes up, Apple tends to go up, Best Buy tends to go up. So you've got these correlation pairs, you see. And of course, the black one is with themselves. So they would just be like one. Because obviously when Apple goes up, then Apple goes up. So that would just be one, really. Yeah. And then what you want to do is find out your return on investment. So you've got your correlations matrix. Now you want to find the forward dividend rate. So $8.36, yeah. And you do that for all the stocks. So then you go to your code, which is here. Yeah. So we're importing NumPy as MP. Now we need our NumPy array, which is our expected return, which we're going to call mu. It's the dollar and cents amount of dividend return for our three stocks that we saw in our correlation matrix, which is BBY, Best Buy, Home Depot, and AAL. Right, so we put in the returns there: $3.68 for BBY, $8.36 dividend for Home Depot, and then we put in 10 cents for AAL, even though actually it says 0, but we're just putting 10 cents in, just thinking. So now we've got ourselves a little correlation matrix here: BBY, HD, AAL, BBY, HD. So it's a 3x3 matrix, and of course BBY correlated to BBY is 1. Home Depot correlated to BBY is 76%. Yeah, 0.76. AAL correlated to BBY is 81%. Yeah, 0.81. So then you keep going, you see, and of course they'll be the same. So look, HD BBY is 0.76. BBY with HD is 0.76. HD correlated with itself is 1, obviously, because when Home Depot moves, Home Depot moves. So it's always 1. That's why this one here, AAL with AAL, is 1. So AAL with Home Depot is 68% correlation, which is 0.68. And then you've got your bottom row here: BBY with AAL, 0.68. Home Depot with AAL, 0.68. AAL with AAL itself is 1 correlation, because obviously when it moves, it moves. So that's your correlation, but you need to put it into the computer, you see. So you set a variable called sigma, an MP array, and you stick this correlation matrix in here. So you see there 1, 0.76, 0.81, and then the next row 0.76. But you see, this is just a simple example so that you can understand it. But what you need to do is do that with all 30 stocks in the Dow Jones, or all 100 stocks in the Nasdaq. That's where the power of this really comes from. Then you set your budget, which is 2. Select 2 of the 3 assets. So you can imagine if it's, once you've got this correlation matrix and the dividend returns of all 30 Dow Jones stocks, then you can say, I want you to pick me 5 out of the 30 stocks, the best 5 that I should buy. Then you've got a risk factor, which is like 70%, slightly higher risk. You could change that to 50%, or even low risk, 25%, depending on how much risk you want to take. And this is where the power of it comes in, you see. And then we get onto so from Qiskit Finance, applications, optimization, import the portfolio optimization module. We set our variable pot, and then we put in our expected returns is the mu, yeah, because that was let's go back up here. So our expected returns mu is here, up here, this array. So we're putting this array in as our covariance is the covariance matrix, correlation matrix is sigma. So we stick that in there. You've got your risk factors, the risk factors, which is there. And then you've got your budget there. So the budget is how many it should pick. And then you go down, QP popped to quadratic program and print it. So what we're doing is minimizing this equation. So it's 0.7 times the first one squared plus 0.6, and on it goes. See, that's just so you can see the equation there, for those who are interested. Yeah. So it says we've got 3 variables, 1 constraint, portfolio optimization. Now we want from Qiskit optimization algorithms, import Cplex optimizer. This is the classical optimization algorithm from IBM. So we put that equal to this variable, and then we put the QP, our equation, our quadratic equation, into the solver. So it's the result is Cplex optimizer dot solve the problem, and now we want to print the result. So here the results are, it says success, you have succeeded in your mission, young grasshopper. And what we're looking for is, we don't really need the val function. What we want is the ones and 1 0. So it's saying the first one, 0, is a 1, meaning you should take that into your portfolio. The second one, which is number 1, because it starts from 0, you see, 0, 1, 2. It's a 1, means you should definitely take that into your portfolio. And the 2, it says 0, don't take that into your portfolio. So what does that mean? What it means is, if we go back to your correlation matrix, yeah, it means take 1, 2 and 0. No, take 1, 2 and 3. So it says take 1, which of course gives you a return of 3.68. Take stock 2, which is $8.38, but don't bother taking number 3, which is only 10 cents return, which is right. That is the correct answer. We would only want to take BBY and Home Depot. We'd want to leave AAL out of our portfolio because the return isn't anywhere near enough. But the power of this correlation matrix and these quadratic programs is when you've got like 30 Dow Jones stocks in your correlation matrix, and also if you've got like the Nasdaq 100 or the DAX 40 or the FTSE 100. So when you've got hundreds, you know, 40, 30, 40, 100 different stocks, that's where the power of this comes in, you see. And that's how the universe began. No, it isn't. That's how quantum and classical algorithms to solve complex problems. What more do you want? Then you'll know what to put in your portfolio. You could make some money.